Okay, all right, everybody. Good afternoon. Welcome to the weekly take on the market. It is 1 o'clock Pacific time. The market just closed Friday, October 25. I'll be your host. My name is Scott St. Clair. I am the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I'm not licensed. Can't tell you what to buy, what to sell, what to hold, how many stocks to own. The webinars, videos are vetted for compliance, which allows us to speak a little bit more freely on process, etc. All right, so we'll get into overall thoughts. Basically, we'll just talk a little bit about the indexes, and then I have a few slides on position sizing based on the Nicholas Darvis uh, book. No, I mentioned it on how to make money in stocks, how I made $2 million in the stock market. And it's, gosh, written in the 50s, I believe, but still a very easy read, a good book. Most of you probably have read it, but if not, I would read that one. So let's pull up the indexes. And today was an interesting day. You can see that. Let's go to like the intraday on the NASDAQ. Market opened strong, tried to go up, made a new high, and then faded a little bit. It's still finished up on the day, but you had a bit of stalling. We were up 0.5%. So maybe it won't qualify as a stall day, but it looks like a stall day, right? Like the market tried to get above this peak and close below it. And this is still, for me, the fly in the ointment. Look at the relative strength. Last time that the market was at this high here, relative to the S&P, that's a big a divergence right there. That divergence still in play to me based on how the market closed. I was hoping that I could forget about that divergence a little bit. Intraday seemed like maybe that was a possibility, but it is what it is. In the end, though, I don't put as much weight in the indexes as a lot of my colleagues, a lot of people out there that follow markets do. Not nearly as much weight as I might have 5, 10, 20 years ago. And I've talked about it before. I just find that the indexes are a little bit trickier nowadays. There's so much money in there. There's the whole passive investing thing. If what's the unemployment rate? 4% or something like that. So I know not everybody's doing it. My daughter's not contributing to a 401k at her work, but the unemployment rate's 4%. Let's say 80% of Americans who work are contributing to a 401k. They just put money into it every 2 weeks or every month, however they get paid. And so that definitely has to have some type of influence on the indexes. They're not buying individual stocks. They're buying indexes or mutual funds that are mirroring the indexes for almost always. The S&P, so that would definitely be a stall day. So it's not distribution, although I don't know what the volume is going to look like, but you basically closed unchanged to down and after being up. So I don't know, not a terrible day, but not as good as it could have been the way it started out. Uh, the the problem, if you're going to force me to pick a problem, it's the bond market, right? So I don't remember exactly when the Fed cut rates, but I would guess it was probably somewhere around there. So they cut rates. What do you think the bonds should do, right? If rates go down, bonds should go up, and it did the exact opposite. Well, this is kind of how markets work, right? What did the market do? Anticipated the rate cut, and when the news came, they sold it. And so this looks really bad, like just not acting well at all. And so this has to be a weight on the market for sure. And the bond market is so large and there's so much money in there, and so it's I think big money is a little weary of the interest rate environment and inflation and what's Fed going to do, and budget deficits and all that stuff that I read about, but I know nothing about. I just don't know how I'm going to trade it. I've tried trading bonds before. I've been short long bonds and futures account. I've been long them. I can't even tell you if I've made any money doing that. So it's hasn't really been worth the effort. So, but uh, this, below all the moving averages, looks like it's back into like a little bear market again. I don't know how far off 52-week high is it? 10%. Guess I could have done the math. 101 down to 92. So, but 10% is a lot more meaningful in the bond market, the 30-year US bond market, than it is the stock market. Like 10% is practically noise in stocks over the long haul. So Dow, I think the Dow, what did the Dow do? Did it do anything today? Yeah, not a very good day. Maybe a distribution day is possible. IWM, not a very good day. Maybe a distribution. How much was it down? 0.36%. So maybe a distribution day. So if you use the indexes, it's a mixed bag. Mostly, I would say, not a great day. A bit of stalling. NASDAQ finally made a new high, couldn't hold it. But overall, there's lots of stocks that I don't want to say that they can be bought, but that could have been bought. I got a list of things that oh, you could have been in that, you could have been in that, you can be in that, you can be in that. And so it's not a bad environment, at least so far for stock picking. Gold is, I think it'll surprise a lot of people that gold is up more than the markets this year. Gold's had quite a year, and then silver, which is, well, PSLV was the one that I prefer to trade. Looks like it's coming out of a long potential base. Who knows? Look at the monthly. I don't know. Maybe the commodity environment is starting to pick up. I don't know. I saw that maybe there was some legislation to I don't know if ban is the right word, but related to palladium, and palladium broke out of this little flat base here. So the commodities market is starting to get a tad bit of life. What else is there market related? China. I know a lot of people ask about China. Just really difficult to trade. If you miss this first move, there's just a lot of gaps. It's trading overseas, gap up, gap down. I just would let it kind of start to trade more normal, ideally, and then maybe you could consider it. I've thought about it, like Tencent and a couple of others, but it's hard to have any size with the overnight risk. It's great if you're in them and they gap up, but it's no fun if you're in them and they gap down. So it's for me, without having the right position sizing, I'm not sure how to trade this market. So I just don't at this moment. All right. So let's get back to the slides and talk about the book just very briefly. So there's a million ways to build a position and or more than one position, but there's the ONeal way, which is, you buy 500 shares at 100, you buy 300 shares at 102.5, and you buy 200 shares at 105. That's like textbook if you wanted 1,000 shares. And I was listening to Jim Ropel on YouTube interview, and he said that the book was written for the average investor. He was talking about how to make money in stocks, not Darvis's book, but that book was written for the average investor. If you're a doctor, a dentist, an engineer, school teacher, you can follow that strategy, and through thick and thin over a lifetime of investing, you're going to do great. It has some flaws, obviously, because you're buying more of the stock as it goes up, and then as soon as you buy that third lot, what tends to happen nowadays a lot is that the stock comes right back in. So it's difficult to buy like that without like a little mini shakeout that might get you out of some or all of your shares. It's just a little bit more difficult. But it doesn't happen all the time. NVIDIA would have worked. Kava worked. Shark Ninja worked. from that old school way. What else is out there? APP. It worked the second time, right? It did fail the first time. It's another thing. You got to be willing to try and try again. So, but then the way Darvis would trade is he would do what he called a pilot buy. I think this was Universal Controls was the stock. And so he bought 300 shares at 35 and a quarter, and then he just waits to see what the stock is going to do. Now, based on the money in his account, like a full position would be roughly 3,000 shares. I don't remember how much money he had in his account at this moment, but let's say this is around 3,000 shares at 35. So it's 100 grand roughly. And so let's say he has $1 million, 10% position. So he'd buy 300 shares at 35 and a quarter, which is nothing, right? 300 shares, it's a 1% position on his $1 million portfolio. I'm guessing. I'm just assuming it was like $1 million. So it's a very small pilot buy, and he just wants to see what the stock does. And the advantage of that is if it goes down and he has to stop himself out, he stops himself out on very little of a position. It barely leaves a dent in his whole portfolio. The disadvantage is starts to go up like he's hoping, and he adds, well, he's buying at higher prices, right? And in his situation, he's buying even more shares in at higher prices. So he's really jamming his average cost when he does this. He buys 1,200 shares, 36 and a half. And I haven't done the math, but I'd guess your average cost in 1,500 shares is about 36 and a quarter. There's no room for error at this point. So you're giving up that little cushion that you develop in the pilot buy when you do this. And then the stock goes to 40 and he buys 1,500 shares at 40, which is outside of what Bill would say, right? Bill would have this totally reversed. You'd buy 1,500, 1,200, 300, something like that. And so he's doing kind of the opposite, like a reverse upside down pyramid, I think is what Mike Webster would call it. And it's just the way he did it, and it's fine. Like I said, there's a million ways to do it. I like this way of doing it, although I don't like the sizing as much. So if I wanted 3,000 shares of a $35 stock, I might buy 500, 600, 700 shares at 35. Let's say I bought 600. Then I might buy 1,400 at 36 and a half, and then buy 600 at 40 or something like that. I would do it something like that. I don't mind increasing usually the second buy, not every time. Sometimes I follow the ONeal strategy as well. I don't know why I do it one way or the other. A lot of it depends on the stock. A lot of it just kind of depends on how I'm flowing in the market. A lot of it depends on how the market's doing. Are breakouts working? But I will definitely buy more. Usually my second buy is a larger size than the first buy. So more along the Darvis system. So here's how he bought Texas Instruments much further into the book. 2,000 shares at 94 and 3/8. 1,500 shares at 97 and 7/8, more along the line of the ONeal system. Not, probably a little bit too many shares in that regard, but at least the price is higher and the number of shares are lower. And then he buys another 2,000 at 101 and 7/8. Well, at least the price is higher, but the share amount is higher than previously. So, like, no real rhyme or reason to this position. Then with Zenith Radio, I just realized I never noticed this before until I was building this. I've read that book 50 times. He bought 500 at 104. There's his pilot buy. And then he bought 1,500 at 99 and 3/4, which is down from the 104 buy. So he was, I think it was near the end, and he was probing. He had a lot of these probing buys, 500 Zenith, 500 XYZ, 200 ABC. And I think he got out of the ones that weren't working, and maybe Zenith was holding up the best. So from a relative strength standpoint, let's say the stock's down 4%, but he bought 10 stocks and the market was correcting, and 9 of them are down 6, 7, 8%, something like that. And Zenith is only down 4, well, that's of all the ones I like, that's the best one. Take money from the others, move it into Zenith. And that kind of mentality and that kind of thought process, that doesn't bother me so much as how he did that. He is increasing his risk. He's averaging down, but at least he's taking money from non-performers, reducing his exposure or keeping the exposure same, moving 100 from 10 bad stocks into 100 grand or 150 grand from 10 bad stocks into Zenith, which is holding up the best. Again, he always had stop losses, so he knew where his kind of worst case scenario was, give or take some slippage. And then the stock starts to rally and he buys another 1,000 at 104, 1,000 at 105 and a quarter, and 1,500 at 107 and a half. So very methodical, but not scientific, mathematical process of building a position. Whereas ONeal's is really very, at least the way he wrote it in the book, you buy half here, you buy the next third, 2.5% higher roughly, and the next quarter or whatever's left, 5% higher. Now, I never saw Bill do a trade, but Jim would say that Bill would trade. Him and Bill were used the same trader at ONeal's desk, the trading desk, and that Bill would trade much more actively than just, buy 1,000, 100, buy 500, buy 300. He'd often just boom, go buy 100. Even Mike and Charles said they'd hear him Bill on the phone, buy another 100 shares of ABC, buy another 100 shares of ABC, and just constantly buying more of it if the stock was working. So in the end, I think it's a personality thing too. There's pros and cons to both of these systems. There's some things that are really strong in Darvis's system that are weak compared to Bill's, and vice versa. So find the system that works best for you. Because I think can't remember if it was Joel Greenblatt, but basically, having a system, having rules is great, but if you don't believe in that system, you don't believe in that process, you don't believe in those rules, when you need that process the most, you won't act. So if you don't believe in it, it doesn't matter what your process is going to be, because when it comes time to act, you're not going to. You write it all down on paper, and it's like paper trading, so it's all great on paper until you get into the battlefield with real money. Okay, so let's go to the industry groups. And we didn't do these last week. Let's see what the industry groups are up to. Telecom infrastructure, God, this stock, is it ARGX? No, it's AGNX maybe. Well, let's look. Why am I doing this? Telecom infrastructure. There's a stock in this group that I messed up. Let's go to top stocks. And I apologize. Maybe it's not in this group. Could have sworn it was, but it gapped up, and gosh, it was AG. It's going to drive me nuts. I apologize that I don't remember, but it gapped up and I didn't buy it, and then my alerts went off and I still didn't buy it, and now it's up like 20%. It did exactly what I was hoping without me. Oil and gas royalty, energy alternative, commercial services, software, insurance, banks Northeast, very, very eclectic group. Media periodicals, computer networking, steel specialty alloys, medical hospitals. Wow, the groups. I just don't, in this year, there hasn't been, in the way I've seen it, like a really good message from the groups and a theme, which a lot of times there are. That's why we follow the groups, because it's solar stocks are on fire, EVs when Tesla's going, or semiconductors, and on and on and on. Oil and gas when, in the 2022 bear market, Tidewaters of the world, it was they were all over the groups. So there's not a lot here with the groups. Let's jump to stocks. I'll turn my camera off. Okay, so we'll start with the big boys. NVIDIA. Turn the pattern rack on. And I don't know what to make of this one. Everybody's in it, but me, I'm not in it. It isn't a great, it's very kind of wedgy, at least the way I look at it. Let's look at the weeklies. Is it as wedgy as I think it is? Maybe I'm just kind of interpreting that it's wedgy because I'm not in it. The volume is declining. Well, Mike Webster said volume's dirty, doesn't matter. So, okay. And I sort of agree with him a little bit in the fact that, like, if I was only allowed to see price or volume, it'd be real easy which I would choose. So the price is the price. It's the leading stock, but for me, I think the heart's out of the melon a little bit. Now, if the market goes up, NVIDIA almost has to go up just because of the way it's structured, the market. But I just can't put my finger on it. It just feels a little bit over-owned to me. Let's look at like Microsoft. So relative strength-wise, pretty poor. So here's the last time it made an high in the NASDAQ. At least the NASDAQ is, or I'm sorry, the NASDAQ is basically here, right? But look at where Microsoft here is. So it's a laggard compared to not only S&P, but the NASDAQ. Apple is holding up okay. Relative strength has improved a little bit. And Tesla, we definitely got to look at Tesla of all the, so it broke out today, gapped up really strong. Not my favorite company, but the price is the price. The action was incredible yesterday and today. Like, it tried to go down and couldn't. Got through the pivot, and then it actually came back down through the pivot and had the potential to be like at least for a half a second a failed breakout, but then even while the market got weaker, this stock got stronger at the end of the day. So no thank you as far as shorting. I just can't bring myself to buy it, but I'll try to save my money as far as shorting it. So on the gold stock side, let's look at like AEM. So this is the leader. I think it's holding up well. You'll see Newmont got torched on earnings here. So if you bought it, hopefully you had a plan to get out, because that went down pretty fast on that day. A-Lab is kind of a new name. So this is what I'm talking about, like from a stock picking standpoint. So I had like a little alert and it went off this day, poked its head up, went back down, but then it closed pretty good. And then it went through there. Now, this doesn't qualify as a cup with handle or anything like that. It's just not long enough. And then at one point it was up like 5 today or something like that. And so I just took it off. It's kind of a volatile stock, so it's hard for me to have any size. Like this was, go to the intraday. This was tough. It ran to 70, and then in this is 60 minutes. But I can tell you, this bar, it ran to 70 and came all the way back to 67, like in 5-10 minutes. And then it was as low as almost 65 for the day. So at one point it was 70, then the next time 65. It's just hard for me to have any size. So maybe I should just reduce the size. That's the what I'm trying to get better at. But sometimes if it's the size isn't all that good, it's hard for me to get excited about the stock, and then I sell it in kind of a moment of weakness or boredom. But this is a name that I think people are talking about. The earnings and sales are good, so acting really well. The whole nuclear thing is, so this is an incredible move, and it just needs to digest it. It could be this, but the longer it holds up, the more, to me, it just needs a digestion, and there could be another lag. So I've got this, like, it's weird. I've got a trend line alert drawn there, and I'm hoping that it just digests like this for a number of days to weeks, and this will follow it down. And then if it just breaks, then I'm whatever. And if it goes back up, I'll try the next leg. But like SMR, it's holding up pretty well. NNE is my least favorite of them. So this one is an avoid to me. Looks like the other two are much better. App, I talked about app a little bit. So yeah, this is what I'm talking about. Like, if you do a pilot buy, you buy here and you never get your second buy. Stock breaks down, you stop yourself out. Oh well, then you do another pilot buy here, and then you either Nicholas Darvis it or you Bill O'Neill it. So if you buy 500 shares here, you buy 300, then you buy 200. Or if you're Nicholas Darvis, you buy 500 here and you buy 1,000 and 1,000. And that's how kind of what he would do as far as getting a position. You see how, like, you just are never underwater if you did it that way. This stock is acting phenomenal. On the energy side, VST, it just needs time. I'm gonna draw like a little, I don't know if I love this trend line, but at least it keeps, I like trend lines because I don't have to look at the stock and it'll just watch it for me for a long, long time. And I'll show you kind of a good example in a little bit. CEG, again, acting really well. It's just a matter of patience, which I'm not good at. So I'm not in these, but I'm not opposed to them. I think they need time. Kava, not a great day today, but look, just trending higher, acting really well. This is kind of one of those ones you just hold and set it and forget it. Reddit, I missed this one. Dropped the ball on this one. New issue, came down, tried to run, built a base, buy point. And my brother uses Reddit for everything versus like Google or any of that. He loves Reddit. He's always sending me Reddit threads. So a lot of people use this product. So this was an airball for me. I should have been involved in this one. Last quarter earnings very good, acting good, nice leadership. VRT breaks out. It hasn't done a lot, but still you're up 8% and you survived the earnings at least. It tried to shake out through the earnings and has held up pretty well. And the nice thing is the revenue, which bothered me, was kind of declining, is starting to pick up a little bit. It's not spectacular, but it's picking up a little bit. So this is a good name as well. C Limited. Sometimes you get to these round numbers and they can run into a brick wall a little bit. I like this name a lot, but I really want to buy it on a pullback. I don't own it anymore. I sold it yesterday or 2 days ago. I don't remember. Can't remember. But I'm hoping to get a pullback. Something like 92 would be ideal. This is the risk I take, because if it doesn't pull back, I'm going to be left in the dust. Reddit, I did VRT. Oh, how about BWXT? Another one I missed. Kind of a weird base, but right area. Nuclear earnings and sales, not super spectacular, but they're there. This name's holding up really, really well. And then this name, which I had not become aware of when it broke out because it's so low price, but I had like a little alert there go off and I didn't buy it. I don't remember why. It moved pretty fast through that, or it gapped up maybe, and I kind of hesitated. But it's some time out. They're out there. And I'm not saying that I would have found this. I didn't find it, or everybody has to find it, but they're out there. The stock goes from 4 to 13. So there's names out there they're doing well. Individual stocks are hanging in there pretty good. Okay, last but not least is VKTX. So this is like why I like to use trend lines. So I had a trend line like here, and it went off and I bought it and got stopped out like within a day or two. And then I had a trend line like that, and then it did that. And so I bought it yesterday. And so that's why I love the trend lines, is they'll follow that stock. And so I don't have to watch it. So this one's holding up really well, or acting well in the last few days. You've got the earnings out of the way. I don't know if that matters. It's kind of biotech-ish. but this is part of that narrative that's right or wrong. That's become a bigger part of my analysis is what's the story? And this is the weight loss drug, the Ozempic type drugs. And what intrigues me a little bit is like Lilly is not acting all that well, relative strength's low. Let me preface that in the not acting all that well in the last few months. It's been an incredible stock, incredible company. So, but I'm a shorter term trader, so I'm looking at that. And Novo is even worse. NVO, look at the relative strength. Look how bad that is. It's just kind of quietly just falling apart. It's down 23% off the highs. And so maybe Viking has something that's better. The trials were pretty intriguing, which caused the stock to really have a pretty good day yesterday, and then some follow through, which is what I really value that. Like, was there any follow through? Like here, there was no follow through. Boom, boom, next down, and then here, so you get 2 days up, and then whammo. And then how about here? Big day. No follow through day. So, or follow through day, follow through. So at one point it was up to 80 and kind of sold off at the close, which is fine. Maybe you had some people that from a margin standpoint couldn't hold it overnight, but this is interesting to me. And so, but the main message I wanted to talk about this one is besides the narrative one, is using those trend line alerts. That way you don't have to always watch a stock that you like. It'll follow it for you. All right, so let's get into the quote of the week. And I'm struggling on quote of the week, so I might have to start recycling. So I was like really searching around for one, but I heard Nassim Taleb, and I've used him before for the quotes on a Bloomberg interview. And what he said about the market appeals to me. So let me quote. Somebody asked him about, so Universa is, and I apologize if I get this wrong, but it's a hedge fund, and they, I think what they do is they buy out of the money, very inexpensive puts, always. They expire. Boom, you get like one of these Japan type sell-offs where the yen is rallying and the markets are, crashing for a day or two. And those puts they bought go up, 50, 100-fold, and they make a bunch of money, and then they rinse and repeat. So he says, let me qualify by saying that Universa is market blind, formerly market blind. In other words, they don't make any market bets. But we're humans, we have opinions about the world. This is really how I think about the market. Like, unfortunately, I have an opinion. I don't think Teslas are great cars. It's right or wrong. That's my opinion. And it's cost me a bloody fortune, unfortunately, but that's the truth. So being human, you're going to have these opinions about the world and stuff. But in the end, you really should just going to be market blind. Your whole goal in the market is to move the account from left to right. Maybe, and then a lot of it depends on how you trade, how fast you do that, with some risk parameters involved. That's all that really matters. Being right has nothing to do with making money. You don't have to be right to make money. These guys are probably wrong way more often than they're right. But when they're right, they make a fortune. And so try not to let your humanness get in the way of you making money. And I'm putting myself on the other side of this camera too, because I fall into that trap a lot, and I'm constantly trying to pull myself out of that when I catch myself in those scenarios. That's it. 800-831-2525, market surge at investors.com. Next week, we have Arnie and Harold will do Stay in Step on Thursday. So I will have next Friday off. So we will see you guys in a couple of weeks. Have a great weekend. Thank you.